Hello traders, Gary Wagner here. It is approximately 11:20 in Honolulu, 4:20 in New York on Tuesday, 17th day of January 2023, and this is the daily report for gold and silver. Gold futures traded to its highest value in 8 months, with the February contract hitting an intraday high of $1,931.80. This resulted in a round of profit-taking, with market participants moving gold lower. Intraday low today, 1906.20, and gold is currently just off of those lows at $1,911.10, a decline of $10.60. Now, dollar strength definitely fed into the equation, but only fractionally. The dollar gained about 0.2%, with the dollar index currently fixed at 102.145. Lastly, silver declined by 1.2% today, or 30 cents, with the most active March contract currently fixed at $24.08. Gold has had a remarkable ascent to higher values since the bottom that occurred on November the 3rd at $1,620. We've had dynamic upside moves, as we saw right at the beginning of the rally, respectable corrections, and times in which gold would consolidate, build a base at a certain area, and then move to higher pricing. Today, gold reached its highest value since April 22nd of last year. That is this vertical line right here. And today's high resulted in a price decline as traders pulled profit. We are currently looking at February gold at $1,910.80, which brings us to an important question, and I believe could lead to an exceptional opportunity. And that is, if we enter a corrective stage, where could gold find support? This first chart is a daily chart, and it has a Fibonacci retracement from 2,078 down to these lows at $1,620, with the 38.2% retracement level at $1,903. It would be the first possible area we would look at for potential support. However, I believe there is the possibility that we could enter a long position a little bit lower than that, and that assumption is based upon a much shorter term time cycle in terms of the chart. We're looking at a 480-minute candlestick chart that contains two different Fibonacci retracements from the first data set, moving from 1620 up to the recent high at 1931, and a shorter term data set from $1,719 up to the most recent highs at 1931. I draw your attention to the 23.6% fib retracement. That occurs at about $1,880, which could be a strong level of technical support if, in fact, today's downward move is the beginning of a real correction. The 23.6% fib retracement in red is from this longer data set here, and that would be where we would look to put our stop at if today's price decline does result in a correction. If gold prices continue to drop, we will send out a special trade alert recommending that you place a limit order to enter the market between 1880 and 1885 within the next day or two. When we convert the 480-minute candlestick chart to a Japanese average or Henkin Ashi chart, it is clear that after this move to an 8-month record high, you can see that we did get our pivotal candles, small-bodied green candles, and then our color change to red. So we do feel as though the probability is very strong that we could see gold decline to our current target between 1,880 to 1,885. A daily Henkin Ashi chart also alludes to the potential for a price decline as we have a return of smaller body size as well as a lower wick on today's candle. Lastly, today's opening letter talks about the fact that there is a huge variation between forecasts by different experts and analysts. To that end, following the credits, we will present a very interesting interview from Davos. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.
I think we have to adapt to it. So clearly we see the impact of climate change. And as you said, last year we had 115 billion losses and the 10-year average is 81 billion. So it's clearly going up. And there's a certain uncertainty right now about the pricing of that. So this is why some of the capital is quite cautious to come back in. And there's a reluctance to deploy capital because we have to adapt. We have to know the new pricing for all of these risks.
Doesn't that just mean the pricing goes up to tempt that capital back into the business?
Oh, absolutely. I believe in market mechanisms. So what is happening now is prices go up quite a bit. Once people see it's profitable, more capital will come back in.
But what does that do then for those who perhaps need to take that insurance? Because then there is obviously a reaction to both the inflation-related higher costs, the impact of interest rates on just generally the cost of capital, and then of course you've got the concerns about having to pay the higher premium.
No, you're absolutely right. But in the end, one of the important things we do for society is giving pricing signals, specific pricing signals. So if people, create houses in floodplains, that's a bad idea, and you can see it in the insurance premium. So over the long term, this is good for society because through these price signals, people will start to build, stronger buildings, will build in the right places, etc. But short term, it's clearly adding to the inflationary pressure.
Yeah. Across the rest of the business, how would you say you are responding to some of the twin challenges that inflation and interest rates present?
Yeah, so this is interesting because both come at the same time in this case, but they're accounted for differently. So inflation, you have to account upfront as much as possible because of existing reserves, and with inflation, you're going to have to pay more for claims. So typically you take all upfront, and companies have started to do that in 22, probably more to come in 23. So there's a big negative at the beginning. Interest rates, as they increase, they go for your investment income, and as you reinvest, it moves up, and that you cannot take upfront. So over the medium term, you're going to see, investment income go up, and that's very positive generally for insurance companies.
Yeah. To what extent do you think the inflation rate is going to remain high for some time? Because I guess the risk is that it eats up the gains that you are able to make from increasing prices. Are we, do you think, on the cusp of a rapid deceleration or disinflation at this point, given that some of the headline figures, like the one we just got from Germany, suggest that we're starting to see negative prints on a monthly basis?
Here you see, I think through this whole, I would say, crisis, we tended to be over-optimistic all the time because we don't think this is going to happen again. But yet we see a lot of, if you think about the underlying, there's a lot of inflationary pressures from the world, falling apart to a certain extent, from climate change. There's a lot of these pressures. And so we believe inflation is going to stay at least above policy rates in 23 and 24. So it's longer term. And also the next 10 years, we don't think we'll ever go back to the levels we had before. So I think inflation is a more important topic going forward. Not at the levels we have now, but it's going to be more